Good afternoon, everybody. Welcome to Trader Merlin Show. It is your Thursday afternoon edition. Yeah, market mayhem, more market mayhem. It's just been absolutely chaotic. And as Margaret says, mayhem, but the supply and demand zones work. They did today. I had a great trade this morning off the first reversal on the S&P, trading the S&P futures, and then I give it back on a trade later on another demand zone that didn't work. But I guess I put market mayhem because of the head-scratching action of the market. We had a producer price index number that came out today, which was incredible. I mean, this is like, wow, are we really seeing no increase in cost month over month? I mean, that's phenomenal to get there. We were at a much higher number. Of course, yesterday we saw that CPI number drop. I thought we would drop a little bit, but man, I did not think we'd get down as low as we did today. So I guess the problem I have is you got such great economic news, which from a market stability piece should be very encouraging, that inflation is under control. That means the Fed now has more freedom to cut rates and stimulate the economy and growth. But then all of a sudden markets started to tank and they just kind of kept on selling off there. It was a pretty ugly day. Most of the index is down over 1%. So let me go and start off with our main pieces here. Of course, more market mayhem was the topic. I'm running out of names for the shows, guys. I know that part of the reason I probably am not gaining any followers is a lot of times you need to have a title that's like clickbait or something very specific. And my titles aren't the best in the world, so whatever. That's why I grow very slowly. So let's go to here. Inflation. First step is going to be the most important part of the day, which I'm shocked. I really am just shocked at that number, at how low it came out at. I'll zoom in here just a little bit so we can see the most recent data and put it into perspective. The last time we were at zero was back in October of last year. Before that, when we were negative, we actually had negative 0.2 back in June of last year. So it's not unheard of to have a contraction here with regards to PPI or CPI numbers. The key is a sustained period of contraction would be good. But the reason this one is so important for me anyway is you notice that it felt like we were slightly ticking higher over the past few months, and all of a sudden we erased all of that. Just kind of shot back down here near the bottom, and now we're at zero. That's obviously great from a long-term growth perspective. It means more freedom for the Fed to cut, stimulate markets, and you would think that would act as a market catalyst. So at face value, I came into today's trading thinking, here we go, we're going to have a ripper of a day. So I'll go here to a 5-minute chart 1 second as I bring up the S&P. If you look here, this is pre-market is the blue shaded area here, kind of after hour session. And you'll notice that we sold off this morning. That first half hour was aggressive sell-off, right? It was a pretty steep decline, but it came right back into the demand zone from the Globex session, right? The after hours. So that was the first trade. I sold out of target. That was great. Loved it. That was the best trade of the day for me. And then there was another demand zone set way back here, right around 55.35, which ended up stopping me out and creating a loser. So could net wash on the day for me. Unfortunately, egg prices are dropping. Oh, great. So we can now go egg people for Halloween. But why? Why would we have the S&P down like this on a day when the news was so good? And I guess it all comes back to uncertainty, that gigantic question mark that looms over our market. So here is the S&P. We'll just kind of bring that into perspective so you can see how ugly this has been. I really anticipated a bounce happening, even though the statistics have shown that today was going to be a negative day, as well as tomorrow. The stats show that. It should be a very slight down day tomorrow. I think it's going to be a relief rally personally. But the current trajectory, you look where we are with the S&P, there really isn't much here to slow it down. Ultimately, I think if this trajectory keeps going, you're looking at about 5,400, 5,440. Will be your next target. So not a good day. I thought we would see some rebound here. I have for the last 2 days. I actually thought yesterday would be a bigger rebound day. We got a small little green candle. That's really one of our first green candles in a while. I mean, if you look back over the last, I'll count the number of bars here to see the actual number of green candles on our screen. Over the last 16 days, we got 1, 2, 3, 4, 5. So 30% of the days have been green, 66 have been negative or down. And the down days are far larger than the up days. So this is a pretty big testament to emotions and what people are feeling in the market. It's pessimism, it's uncertainty. And again, inflation you would think would be a piece that really helps that out. It looks better, right? It looks better, Bert. It looks better. Well, that jumps us into the topic du jour, which this was what many people's concerns were, that the tariff war would start out as, okay, I'm going to posture. I'm going to say 25% tariff here, 25% tariff there, and then I'll backpedal, right? The art of the deal. Like when you go to Thailand and you go to buy a shirt at the store and they go, oh, it's 1,000 baht. And you go, no, I'll give you 100 baht, right? It's negotiations. And then you work and finally you buy the shirt for 300 baht. So it's never that 1,000 that you started with. And you get some lower numbers. Now, the concern is that you start to do this type of tariff war piece where you slap on a 25% tariff somewhere and that person goes, oh yeah, well, screw you. I'm going to put a 50% tariff on this stuff and that stuff. Now all of a sudden we got tariffs on bourbon. My Friday shows are going to get more expensive, although most of the whiskey I drink is domestic, so I'm not too worried about it. The good news for me is I'm not a huge wine drinker. I do like a good Chianti or Brunello Montepulciano, but I'm not so worried about that impacting me. So long-winded, why am I going into all this? Well, Trump, if we go through the tariff talks here, which is the topic du jour, Trump said 25% tariff on aluminum and steel from Europe. And Europe said, oh, that went into effect last night. Right? That went into effect last night. Europe said, oh, yeah, well, 50% tariffs on your bourbon. And instantly, Trump says, if you do that, I'm putting a 200% tariff on all alcoholic beverages coming from Europe. It's like, oh, here we go. It's going to go. Not that any of this will finally ultimately hit the end bottom line, but I do think it totally stokes the fears of massive uncertainty. We just have no idea what the final resolution is going to be on this at this point. For those of you that are big champagne drinkers, you might want to buy your cases of Dom Perignon now, because if you do get a 200% tariff, you could get a hefty markup on eBay selling this stuff after market. And I agree with Jimmy T. I grew up in NorCal. I am a big fan of Sonoma and Napa wines. They're good stuff. Now, I also lived in Italy, so I almost sound hypocritical. I hate to say it. I like Italian wines a little better. Shoot the messenger. I know. But yeah, you got plenty of wines in California. And I think that if this tariff does happen, what's that going to do to wine prices here in the States? It will drive up demand significantly for U.S. products, and of course that would result in inflationary pressure. But at least the wineries out here in the United States will get a much fairer shake, I think. Now, I don't think it's going to get to a 200% tariff on European alcohol, but you never know. Wilder things have happened. Let's see. It's more like you get a tariff, you get a tariff. Exactly. It's the Oprah Winfrey deal. Steve says, I would assume that this stuff takes place all the time just behind closed doors. Trump likes to make it public stage. So I think that this is one of the main reasons you're seeing that negativity in the market, which to me is actually good long-term, right? Good long-term. And why? If we get a market panic, a market sell-off, it gives us a good buying opportunity. If the buying opportunities are ripe enough, meaning that the price that you're getting, you look at it, you go, I'm happy to own this stock or this company or this product or service at this price, then don't worry about the short term. Buy it at a price that you're content with. Because if our economy is in fact getting better, now inflation, of course, was that piece we talked about with stagflation on Monday, I think it was Monday, where inflation is a major part of that. Now, I think inflation is going higher, but man, the numbers came out today showing significantly lower than expectations. Are they cooked? Do we trust the numbers? That's always another topic of discussion. Bottom line is, it looks like the economy is doing better, and that means that the Fed will most likely start to cut interest rates even more, even though I think they should still hold. They will cut even more to stimulate the economy, probably because Trump is pressuring him as well, and that could lead to more domestic success, more economic growth here in the U.S., even with the impacts from the tariffs. Remember, we're the largest economy, so when we have a trade war with someone like Canada or Mexico or even the EU, generally they're going to feel it much worse than we are because we're the largest economy. So at some point, this sell-off here, which is looking pretty darn ugly, will turn into a great buying opportunity. Now, as I've mentioned on the last couple of days, Margaret says NVIDIA and Apple. Yeah, I have NVIDIA at 115, and again, I have calls sold against that position. So if I keep my position 115, I'll be totally fine with that. But there's a lot of other stuff that you could be looking at as potential buying opportunities. I mentioned Tesla the other day. I still have my Tesla 210 puts. I still have, what else do I have? I have SMCI, but I have calls on my position there. And big companies that last, correct. The question you have to watch out for with somebody like an Apple or NVIDIA might be, does Europe say, oh, okay, if you're going to play that way, Mr. Trump, then we're going to tariff all products coming from the United States. And that could have a big impact on multinational companies like Apple, right? Apple sending iPhones around the world. So that may have an impact on those companies as well. So be selective out there. But for me, I think it's going to create a fairly decent buying opportunity. The catch for me anyway, and this is with how I'm thinking with my money, the catch for me is if I find a good buying opportunity and this market continues to fall, I'm okay with that. What I have to keep an eye on is the data, right? I got to go back here and look at this data and see what is it starting to change, right? Is this a one-off drop that we went from 0.4, we were at 0.4, it dropped all the way to 0. That's a pretty steep 1 month drop. Cookbooks, quite possibly. You look up here, even better when you strip out food and energy, look at the core PPI number. That was negative 0.1. I mean, last time we were negative was back in April of 2023. Before that, it was during COVID in July. So this is a very good number because energy prices have been falling. We've been looking at that crude oil chart, and we can look at RBOB as well. But I'll bring up crude oil since I just happen to have it right here. You know, crude oil has been falling fairly aggressively, and I have echoed this many times. I do think we're going to continue to go lower. Would not surprise me to see a little bounce, but ultimately this goes lower. So this dropping impacts those inflationary numbers even more, and that creates a bit more optimism. Now, what does that translate to? Well, that leads me to believe that you're going to see more rate cuts this year. And right now, what I'm showing you is the probability for the December rate cuts. Where will we be? Right now, we're at 4.5% on our rate. The expectation is we'll be at 3.75%, so 25 basis point cuts by December, and that probability is getting higher every day. This whole curve is shifting more and more to the left, and when I say to the left, that means lower rates, lower rates, lower rates. So I find this very interesting. I think right now it does paint somewhat of a very positive picture for the longer-term prospects of the market, although we'll have some shorter-term volatility. But data is going to be really, really, really key here, and keep an eye on. And of course, you're watching the show, and you know I'm going to keep looking at this stuff every month. You know, as we progress, it'll be going back into the three main pieces, which are going to be GDP, the unemployment numbers and jobs data, as well as the three main measures of inflation in the U.S., which is the core PCE price index number 1 that comes out in a couple weeks, and then you have PPI and CPI, which of course came out over the last couple of days. So, man, I was kind of bummed. I thought we'd have a bigger rip today. I thought this was going to be a ripping day of markets just going crazy because these inflationary numbers were so good. But yeah, who knows? Crazy. What did Steve say? I think the China tariffs are beating up Apple pretty good already. Yeah, but if other countries start adding to that problem, it could hurt Apple even more. Strip out food and energy. What else is there? Correct. Housing, transportation. I don't know. It's just silly measure to me, honestly. It's the core. Yeah, I'm not a big fan of that measurement. So is the idea that lower rates will offset price increases due to tariffs? Well, I don't think that the connection from Trump is that lower rates will offset tariffs. I think that Trump's saying, I want lower rates to stimulate economic growth in the United States, right? So the lower that short end of that yield curve goes, the cheaper money becomes. Now, that is a result of many maturities on that yield curve. Now, the 10-year is also another indicator of growth. That's the cost of capital. And we saw that drop 1%. We're at 4.27. You know, if this keeps up, we could see this continue to drift much lower. I mean, right now, as you can see, I've got that 4% kind of marked out as the next logical stop here. But I'll be honest, this is very hard. Listen, to complicate matters, we're getting into contract rollover on the indices. That certainly does add to it. But I would say this is the hardest time to trade because you don't know. One tweet, one press conference, one bad piece of data can cause this market to go absolutely reeling, and it's been a wild ride over the past 45 days. Although it's been good for my pocketbooks overall from a trading perspective, from a market perspective. I mean, this has been wildly volatile. I mean, if you go back here, I'll put two little vertical lines. I'll put one on the day where Trump won the election, which is right here on Tuesday the 5th. And then we'll go to January 20th when he took office, which is right here, 20. I don't know. There you go. I'm not sure why Monday the 21st isn't showing up on my thing. But from when he won the election, we saw a nice rally up. From when he took office, it surged at a double top and hasn't looked back since. It has not looked back since. Yeah, Steve says you can't hold anything. Right. I think for the longer term traders, this is brutal. And we've talked about that on how anybody here who's a long-term investor, protection might be the way to go, right? Buy some puts, delta it out, make sure you got your position covered. Maybe even lock in some profits by selling if you're okay with taking the tax hits. But yeah, to me, really swing trading, which is a couple days, a couple weeks, are actually the best way to go. And day trading. Day trading's been a lot of fun, although extremely volatile, and it can be very difficult if you don't know what you're doing. As it stands right now, personally, I do believe that this is too steep of a sell-off. I think it's too accelerated. So normally what happens is you'll get a sell-off this sharp, and then it rebounds and continues its sell-off. We have not had this, right? We have not. Oh, thank you, Liz. MLK, that's right, it was closed. I was wondering why I didn't see it on my charts. Thank you. But the trend line for Margaret, if you're talking about the uptrend line was broken long ago. And we could put on a wide variety of moving averages on here, which would all confirm that. Let's go to the broadest measure one, which will probably going to be above it. Oh, no, we actually broke below it on the 10th. So we broke below that 200 period moving average on the S&P 500. This is a very big thing. Typically, hedge funds don't want to be holding positions if they're below the 200 period moving average. It's a sign of bearishness. So at this point, we've seen an expansion above that 200 period moving average. And as I've mentioned before, I always want you to think of a moving average as an arm, right? Think of that as your arm, and price is the rubber band around the arm. So the further that price moves away from its moving average, the more likely it's going to snap back. And you saw it happen a couple times, but really since 2023, October of 2023 was the last time we were below that 200 period moving average. That's a remarkable amount of time to be above a 200 without coming back down, and now we've broken it. So in the true form of elasticity of price, what will probably happen is, again, it's down below the 200, it'll maybe sell off a little bit more, and then it will retrace and come back and test that 200 period moving average again. Jeff says, do I have much faith in the 200-day? No, I don't have a lot of faith in the 200. The reason I like to look at the 200 period moving average is because of mass herd psychology. It's one of those things where as soon as something crosses below a 200 period moving average, all the experts are talking about it. It's talked about on TV. Oh, it's below its 200 period moving average. And it's also one of the components of the death cross. You guys have heard of the death cross. That's where the 50 crosses the 200. I haven't seen if we're below that yet. Let's look and see. Let's check and see if we've got the good old death cross. If we don't have it, we're going to get there soon. Let's go to moving average. Out on the third one. And we'll do a simple. And I'm going to make this one a 50. All right, so there is your death cross. So we're not there yet. But if we keep sliding like this in another couple weeks or a week or so, we could certainly be down below the 200 period moving average on price. The 50 could cross below. And you notice that just over the past couple days, or past couple weeks, you've seen that 200 period moving average start to slope a little. The curve is starting to slow down a little bit. So you may actually get this to start to roll over here, and that would be a bad thing, right? If the 200 period moving average is pointing down, that's an extremely bad thing. It's one thing if it breaks below it like price did here last week, right? On the 6th, it's broke below on the 6th of March. Let's just go back historically and look last time it closed below. Notice that back here when it broke below the 200 period moving average in October of 2023, it was still pointing up. And really the only time I've seen it really point down is between this little window of time here, 2022. So from January 24th of 2022 all the way through, I'll call it March of 2023, that 200 period moving average was moving down. And you notice it rallied up, hit it a few times, and ultimately stayed below it. So at this point, we're now down below it. I'm not totally convinced yet that this is done, but if we get a rollover here and the 200 period starts pointing down, then it's a close your longs. Shorts are coming. If you get a death cross, what does that mean? Again, Steve, it's just one of those market mantras. It just means that the last 50 days have been weaker than the last 200 days, which means momentum is selling off more than it's showing selling pressure, showing a complete sentiment change on the part of the buyers and sellers in that marketplace. So a death cross, and there's also called the golden cross. So the golden cross would be like this, where you see back here on January 30th of 2023, we had the 50 period moving average cross the 200. and that is the golden cross, right? That tells you that shorter term prices have been moving up faster than the longer term prices. And there we go. It means YouTubers like Johnny Bravo claim the world is ending. Yeah, well, we know that's not the case, right? We know that's not the case. We know it's just a cycle, a phase, a move in the market, which will equate to opportunity. So I, for one, I've expected a pretty significant pullback in the markets. I didn't think we were going to get it right now. I thought we were going to get this maybe late second quarter, third quarter. I thought the tail end of the year would be fairly bearish, but boy, kind of surprising me that we're getting hit this hard with such an aggressive negative sell-off in the marketplace. So if we go from the high that we established here just a couple weeks ago on the S&P to where we are right now, we're officially now down below 10%. So now what can happen is there's these thresholds in the marketplace that to me are merely there to precipitate fear. They're nice because they're benchmarks so you know the market's doing this, but it also precipitates fear. So number one is a correction. A correction is 10% pullback or more, right? So now we are officially in a market correction. Okay, big deal. The next one would be a bear market. Now, a bear market, as you guys know, would be 20%. So 20% off this would be roughly right about, I'm so close. I'm splitting hairs. There you go. Call it 49.30 on the S&P. That would be another pain point. Now, if you want to know why I got kicked off of CNBC, if you would like to know the clarity of that one, I can explain it to you. You just got to tell me if you want to hear it. I think some of you actually heard it. Okay, another 10% I'm going shopping. So will I. I will also, Oliver. I think if it got down 20%, it would probably create a pretty good buying opportunity. Yeah, 4,900 would be 20% off the all-time high of the S&P. So, this number becomes very relevant. And for me, this is why I got kicked off of CNBC. So let me just read the number here. So the high from February 19th, I'll write it down here. The high was 6,166.50. Okay? Glenn wants to hear it. You guys want to hear it? Okay. So let me explain why I got kicked off of CNBC, what the logic was, what the mindset was at that moment in time. And I think it's very relevant because we could be facing that same situation here going forward. So let's go back into when I was kicked off CNBC. That was in 2008. We'll go past all this mayhem that happened. Geez, so much happened. But I want to make sure we get past all the good stuff. We'll go here in 2008. Okay. So here we were in 2008. So my first experience on CNBC was in December. So right here, of 2007. I was in Singapore teaching a class, and the center owner knew the guy from CNBC, and he said, "Hey, we'd love to have you come on." I said, "I'd love to go on CNBC." Sure. And when you're, as a trader, you feel like that's it. Like you've now made it to the promised land, right? You're on CNBC. As a trader, it's kind of like one of those life goals, right? Get on CNBC, and you're like, "Yeah, I made it." What a joke. I really don't have any interest in going back. Of course, if they asked me if I wanted to come back and be a guest on the show, I probably would say yes, just because why not? But I was on there, and they started asking me all about the markets and where I thought things were going, and all was good. So they came back on in January. There's December. I came back on in January, and it was like January 8th. I actually posted the video, so there should be a date on it. But if you look here and look at the all-time high, it's 1586. So 1586 was the high back then, and this is the futures market. I think I actually have this with the rollover too. Let's go 1586, and what I just mentioned to you guys was a bear market. A bear market is 20% off the all-time high. So I'm going to go times 0.8. So this is slightly off. It was 1256, but it's showing 1268. Okay, 1268. So let's put a line right on 1268. When I went on CNBC, they asked me about where I think the markets are going, and I said if we break, it was 1256 at the time, but I'll just use 12. There you can see the line. I said if we break this, break out the bulldozers. We're going down in a big way, because this should act as a psychological buy point. Institutions are going to, at 20% down, they're going to be buying, and that should cause it to bounce. So look what happened. It tiptoed down below it. We didn't close below it on January 22nd. January 23rd, we didn't get there. As soon as we broke below this and closed below, the day we closed below, I opened up large short positions there. So we actually ended up closing below it in July. And I opened up large positions in SDS and QID. Those are double leveraged shorts. Turned out to make my year. That's for damn sure. But the main reason was I felt that we would be bouncing off that 20% pullback. And there were certain factors that happened here. So right here where my cursor is, where you see these long bottoming tails, I believe this day, January 22nd, was where the Fed said they're cutting rates by 75 basis points. They came out, I think it was pre-market, and said we're cutting by 75 basis points to juice the market up because they were just starting to panic. And ultimately, all I was focusing on was 20% off of the S&P. Let me see if it's SPX is actually the more accurate numbers. It should be SPX. Let's go look at that same picture. Sorry. I'll try to spare you all the scrolling here. It's going to be a long one. It was 1556 or something, so that's the all-time high. 1576. So that was the number I went off of, 1576. So I go 1576 times that by 0.8 is 20% off, 1260. So 1260 was the number that I had, that I was on CNBC telling them, if we break this number, break out the bulldozers, we're going down in a big way. And I got kicked off. So those that haven't heard the story, here's the way it happened. I was picked up by a limo from the Trading Academy office here in Irvine, and they drove me up to LA in a limo, and I was like, baller, right? Baller status. Limo said to pick me up to drive me to LA just to do a segment on CNBC. I was like, are they going to make me a job offer? And I get in there, and there's Amanda Drury. They had me in a studio, and I was connected virtual to the different office. I forgot where it was. I think it might have been in Asia. And she starts asking me about all kinds of different things. She says, what would you like to talk about today? I said, I don't care. I don't have a script. I don't like to have a script. I like to freeform. If I mess up, I mess up. I'd rather be organic than totally like reading a teleprompter, as a lot of these guys do. So she says, okay, well, we'll talk about this. And I said, oh yeah, let's talk about gold. Sure, S&P, great. So we went to this topic, and it was, what's your thoughts on the S&P? And I was like, okay, great. And I had a little earbud, right? So they were giving me cues. I was supposed to do 2 segments. So at the end of the first segment, we started talking about the S&P, and she says, hey, what about S&P? What do you think about the S&P? And I'm looking at this chart, and I said, look, I think if we break 1260, we're going down in a big way. And I think I went like this because I had bulldozer cufflinks on that day. And she's like, oh, okay, all right. Well, what are your thoughts on gold? And in my mind, I'm like, you just had a guest tell you that if we break this number, we're going to go down in a big way, that we're going to crash. I don't know about you, but I'm pretty sure if any one of you were the host, you would have been like, hold on a second. Explain why. Why do you think we're going to crash? What's your logic behind that, right? It's just an opinion. I was just blown off, no question whatsoever about why I called 1260 on the S&P 500. And then she asked me about gold and was like, why do you think gold's going to go to, I don't know, 1,000 or 2,000? I said, it's not a question of if, it's when. I go, you guys are sitting here on CNBC talking about, is gold going to get to this number? You're like a Ouija board. Of course it's going to get there, right? Just like gold hit 3,000. Well, almost hit 3,000. Missed it by 30 cents today. So in my earpiece, after they go to commercial break, the guy goes, okay, you're done. And I'm like, we have a whole nother segment to talk about stuff. Like, no, you're done. And I literally got kicked off of CNBC, and I believe it was because of my bearish comments. I believe it was because, I said these markets are going to crash. And look, at the time, I don't think it's that outlandish. I mean, look at the chart. I mean, I was on when we were right around here. I think it was January 8th, so we weren't even that low yet. But I think you notice a similar picture here. The markets had a great uptrend. They started getting lower. They weren't making as high highs, right? So you can see here we're making lower highs all of a sudden, and we started making some new lows. So for me, and right here, actually, as you got to January 18th, we actually broke the swing. We broke the pivot. That's huge. That means we're no longer in an uptrend. And so now, once we break that 20% mark, then we're off to the races to the downside. So that was the story behind getting kicked off of CNBC. And I'll tell you, we're in a situation right now where I'd argue we're in a similar situation, right? What have we had? We've had a aggressive, long uptrend, honestly, for an incredibly long time. Since 2009, other than the COVID, pandemic blip we had, we've been in nothing but an uptrend. So what was concerning for me 2 weeks ago was, okay, well, we're not making new highs, and we broke this swing low, which was right around 57.78. Now all of a sudden we're breaking the 5,700 level, and now we're coming towards this 5,400 level. So we're falling way more aggressively than I think we should be. I don't think that this sell-off is justified. It just tells me there's panic and fear in the marketplace. Typically what would have happened is we'd rally back up and we make a lower high, sell off, make a lower low, and start that downtrend pattern. We haven't had it, right? That's why I've really been anticipating a bounce back up here, because this is just too sharp without a relief rally. A 10% sell-off without a bounce is pretty significant for a broad market index, right? For Bitcoin, no problem. For Bitcoin, it's just called a Tuesday. But for this, tough. It kept dropping in some more from the supplies and above. Did it after that. So it did fall to 20%, which is at 1260 on the S&P, and then it bounced, tested it again. And why the reason it bounced, and this is actually pretty important. I'll scroll off camera so you guys don't get tortured. The reason it bounced back here in 2008 off 1260 was not because of just normal market behavior. These bounces here that you saw on January 22nd and 23rd of 2008, plus this one right here on March of 2008, that was the central banks slashing rates aggressively to save the market. They were cutting them. One of them was a surprise, I believe. They were cutting rates aggressively, in my opinion, to help support that. We don't want to go below 1200 or 1260, right? A 20% drop now spreads fear. If we get below our current, that 20% mark I told you about, which I'll scroll over here and show you that one. If we get below the level of 20% in our markets, which I already took off the screen, but I think I can get it back here pretty quickly. Oh, it's because it was on the futures. There you go. There's the 20% mark. If we get below that 49, call it 4,900, right? We get below 4,900, then every newspaper, every magazine, every TV show will be saying we're in a recession. We're in a bear market. We're going to, and what does that do to the average person, right? You guys are all experienced traders, but just think about someone who's got a 401k, a retirement account, someone who doesn't understand trading and investing very well. They're reading all these headlines, we're in a recession, markets are crashing. What do you think they're going to do? Those people are going to panic. And they're going to be like, I call their broker. Oh, God, I want to go to cash. I want to go to cash. Please, just get me out. Well, hold. No, go to cash. And it just creates more panic. So that was my bet back then. And we did have, it broke below 1260, rallied up back above it, and then once it came back down, it just fell apart. But my whole trade on that was based off of a really strong uptrend, slowing down because you can see it on the price charts. You can see the lower highs coming in and lower lows, trend reverse, no question about it. Number two is knowing how people respond to different market stimuli, whether that's a moving average, a Bollinger Band, or a bear market at 20%. That was what I was looking at. Sell it to me? What do you, exactly, Chris. I was thinking if we get a bounce to your yellow box, buying puts. Yeah, I will too, Steve. I do think that our uptrend is done. I'm going to be clear. I think our uptrend is done. I do anticipate, I might even just move this. I'll keep torturing it. I'll move it there. But I do think you're going to get a retracement back up. And what would be interesting here for those who are thinking like Steve and myself is, you know, you've got a market that's rolling over. You have a 50-period moving average that's now pointed down. You have a 200-period moving average that's starting to flatten out. By the time this bounces back up to that yellow box that we have drawn on the screen there, which is between 5,724 and 5,760, once we get there, we may be actually hitting right on that 200-period moving average, right? I love it. Hump and dump. Yeah, it will be the market hump and then dump it. FUD is a sign of good things ahead. Yep, love it. And Chris says Buffett's got to just be salivating right now. And my guess is he's waiting. My guess is he's waiting even more. He's been out for a while. So the media is stirring a giant frenzy. Liz, let's be clear. The media always stirs a giant frenzy. Right? When have you seen the media calm the world down? No one wants to read, no one's going to watch the evening news to watch a fireman rescue a cat from a tree because that's good news. No one's going to watch, a story about a young boy who helped an old lady cross the street. That's the the substance, the good stuff in society. But nobody wants that. You want to watch the car crashes, the fires, the murders, planes falling out of the sky. You want shock factor. So every media outlet in the world is going to sensationalize this and be like, doom and gloom. Here we go. Market's falling apart. Crashes here. Recession. Are we going to have a depression? You know, that type of fear-mongering pops up. Ugh. Drives me nuts. And we just kind of sit there and try to make our trades, make our money based off of those moves, and don't formulate too strong of an opinion. I'd say would be my overwhelming caution for this one is whether you're extremely bullish or extremely bearish, totally up to you and how you play it. Just don't hold on to that opinion, right? Don't hold on to that opinion. Data, not bad, but markets are diving, yeah? And I think that's the fear. That's fear of uncertainty. Trump definitely stoking that with this tariff war stuff, which, you know, we just talked about here. So I think that this is going to escalate a little bit more, but I don't think we'll implement 200% tariffs on European alcohol. That would be kind of crazy. Let's also bring up this chart here. So I talked about gold hitting all-time highs for the next couple weeks or so. I didn't think we'd hit it the next day. These markets are just irrational. I mean, look at today's move. It was just fantastic. Now, it hit all-time highs, but it did not. It did break 3,000. It hit 3,001. That's weird. I could have sworn it. Excuse me. I could have sworn it didn't show that. Let me go 5 minutes here. Okay, because it just hit it. Yep. So we literally just in the last 5 minutes in the after-hour session just broke above 3,000 on the COMEX Gold. We had $3,000.01 is what it rolled over to in the after hours here. So pretty impressive. And again, this does, in my opinion, reverberate the belief that people are panicking. There's just too much uncertainty in our market right now. Steve says, Merlin, if inflation is going down, why the run on gold? Uncertainty. Gold isn't just the flight because of inflation. It's market uncertainty. Remember, money's going to move from one place to the other. So as this money comes pouring out of the equity markets, when you look at a sell-off like this, let me get the S&P, money's screaming out of the equity markets right now. I don't know the exact amount, but I'd venture to say there's been several $1 trillion worth of capital has been sucked out of the equity markets. Where is it going? Well, you could make the argument, bonds. We already talked about that, right? The more demand we get for bonds, the more yields will drop, and we've seen yields dropping. So that could be part of where you notice it's almost the same as the market, right? So bond yields reflecting that as the equity markets tank, I think yields will also start to tank. And that's where it becomes, like TLT becomes an attractive option, because if bond yields continue to fall, the price of TLT should continue to move up. So gold is that just flight to security. It's knowing I've got something tangible. They can't print any more of it. They're not going to manipulate it. There you go. And they may go to cash too, right? It could be going to cash, which might not be the best option given how strong the dollar is. I say that sarcastically. The dollar has not been strong at all. Right? Dollar's been incredibly weak over the past several months. Since the beginning of the year, actually, the dollar has fallen significantly. It's not like a Bitcoin kind of crash, but remember, this is the purchasing power of the U.S. dollar around the world has fallen roughly almost 6%. That's massive. It doesn't seem like a lot, but it is certainly a large amount. You should have James Altucher on the show. Is it? I think that he's a guy that got like a little frown. I think he's got like a little afro. I saw some of his stuff, and if it's the guy I'm thinking of, I would never want him on the show. I feel like he's just a sales sensational guy who's always trying to sell his products and services, and I don't know. Musk found an IOU at Fort Knox. Look, I think with regards to gold, if we do get the audit, which is interesting because we talked about this audit over and over and over again, right? What happened? I'm sorry, I haven't heard anything since the world's kind of going, yeah, audit it. Absolutely. Elon Musk posted a tweet out, said, what are your thoughts on auditing the Fort Knox? No, yes, or hell yes. I checked hell yes, right? Let's do it. Hell yes. We haven't heard anything about it. Look, I think gold is a win-win either way. If we get there and all the gold that they say is there, then price of gold holds up. If they show the audit and gold is not there, I think gold surges. And maybe that's what people are a precursor to. They're just trying to get here right now, is buy some gold because it's not at Fort Knox and they don't have what they say they're going to do, which means it's even more scarce So I think this is going to continue. I've been saying this for a long time. The trend is your friend till the bend at the end. We haven't had a bend. We had one little blip here. We kind of made a new little tiny swing low, but it's stabilized and still above its 200-period moving average, and it's been above that since 2023. So all looks really good. Yeah, haven't heard anything about Epstein either. Remember we saw this the influencers walking out with the binders from Capitol. Like, hey, look, we got for the White House. We got the Epstein files. I haven't heard anything. I haven't heard one word about that. Kind of crazy. Flight to security at all-time highs. Hard for me to buy gold when it's this high. I know. I'm not buying any more. I have the gold that I want, but yeah, it's tough to buy something at all-time highs. But maybe, Steve, your approach is I'll buy pullbacks on this one, right? So maybe you're selling puts on GLD at lower levels and collecting that premium. And if you get it, you get it. Certainly, Rob says running out of supply. Yes, we are running out of gold supply. There's only so much gold that we can get from this earth. You can come up with better mining equipment, better resources, find some new gold veins in the earth somewhere, but there's only so much out there. How much, we don't know. What we do know is how much Bitcoin is out there, which is why I'm surprised Bitcoin has been struggling so much lately. It's that, look at Bitcoin's price chart today. It was doing great earlier. We were doing fantastic. We actually had a high intraday of 84,000. I was liking that, and all of a sudden we've fallen all the way back down, 3.5% slide today on futures to 80,245. Not looking good. Not looking good. Oh, yeah, let's talk about SLV. Talk about, gold and silver. Silver's been on a tear lately too. Right, just been ripping to the upside. You had a big move up today for silver, trading at 30.82. Again, I'm bullish on gold and silver. Definitely bullish on gold and silver. Let's see. Crickets on who killed JFK. I think, didn't Trump say, he said something about it, like why he didn't want to release it. If you knew what I knew, then, you wouldn't release it. Okay. I think we're all adults here. I think we can understand it. TD said gold be made by a man now, although it is not as pure. Really? Gold can be made by a man? Who are you hanging out with? Rapunzel? Oh, no, that was Rumpelstiltskin that could make the gold. I did not know you could make man-made gold. Well, that certainly would hurt. It's purity. What else did I have on here for today? Oh, let's talk about this one. So, as you know, actually you may not know, but I did a session. Some of you were in my digital assets program, and I kind of came up with this 4 steps of evolution for digital assets as we speak. And one step was the strategic Bitcoin reserve. Second step is the digital asset stockpile. The third was stablecoin regulation and making sure that we get stablecoin framework in place so that it removes a lot of this crazy uncertainty that's in the place. Well, in the market. We had a bill passed today. It's called the Stablecoin Genius Bill. I forget the guy who wrote it up, but this one passed today, the U.S. Senate Banking Committee, on an 18-6 vote. Now, what this does, in my opinion, is very good. It establishes the framework for stablecoins, how they function, what they have to do, the requirements, the oversight. Should have been done a long time ago, right? Stablecoins are going to be here no matter what. We should just embrace them. So, of course, Elizabeth Warren is spearheading a whole campaign to go against it, and no, this is bad, it's corruption, but look, all of this stuff has teams that oversee it. There's teams that oversee stablecoins. And I went through and wrote down a bunch of different stuff for this. Number one, stablecoin reserves cannot be commingled with issuers' funds. So if someone buys your stablecoins, those funds need to be held separate. That's called a safety. Loomis was the strategic Bitcoin reserve bill. It was another guy that did the Genius bill. It's an acronym for something. I don't know. Government ingenuity. I have no clue what the acronym is for, but it's called the Genius Bill. I know it's an acronym because it's all caps. Let's see what does. And for. Probably has a term to it. Guiding and establishing national innovation for U.S. stablecoins. There you go. That's what it stands for. Liz needs to retire. Wait, what are you talking about? Are we going after Liz today? We all want to retire, don't we? Let's see. I'm trying to see if Liz commented on this. That's why I saw Liz needs to retire. Oh, I can head down the road to Fort Knox and check what's there. Please do. I would love to see. I really want to know what is in there. But yeah, that's what the Genius Bill stands for, is guiding and establishing national innovation for U.S. stablecoins. It is proposed by, let's see, who? Senator Bill Hagerty. So Senator Hagerty proposed this one on February 4th. So there we go. Anyway, this is a huge piece for us. I think it's incredibly beneficial. This is really good for clarity in crypto. The fact that it was faced with such angst from Elizabeth Warren and her crypto army, as she calls it. Oh, Elizabeth Warren, yeah, I agree. Yes. Well, Liz maybe wants to retire. Both Liz's. Yeah, I think Elizabeth Warren, on many fronts, I think she has some good points, and consumer protection, I think, is really important. You know, and she has done a lot of good. But it really just kind of surprises me how she has dug her heels into this. Crypto is the devil. It should never be anything. Yeah, Pocahontas. It should never be a part of society. I think that is just a bad look for her, and I think it's really damaging her reputation in the industry. Certainly there's some people that still think that crypto is a scam, but I don't think anyone could argue that the dollar is going to go digital. So stablecoins represent a digital dollar that we can use to interact with all of these digital networks. So why not create rules to protect investors? Absolutely. Absolutely. See? Our Liz is retired. Liz, maybe you can convince the other Liz to retire. I was really surprised she actually won that election. I thought she was going to lose. And last part here, just in passing, is this government shutdown. People have asked me, am I concerned? Am I worried about it? I'm not. Look, they're probably going to pass a stopgap, kick the can down the road. And if they do go on a strike, I'm not worried about it. Maybe the Republicans decide to force a government shutdown just so we can see which government offices function when, people aren't getting paid. I don't know. I'm not worried about a shutdown of government at all. In all the time that I've been trading and kind of paying attention to this stuff, a government shutdown really doesn't impact the markets too much. Obviously, the longer they go on, the more there will be an impact. But if anything, I think this is going to be a political move, and I think it'll all be fine. All right, let's go to our markets. We've already covered a lot of this stuff. We talked about Bitcoin. Let me get these moving averages off of here because I don't like moving averages on my charts. There we go. We got that crude oil still stuck down at those lows. Still am of the opinion that we're going to see a bounce at some point, but we haven't really gotten it. It's been a tiny little bounce for crude oil, but nothing dramatic. Your NASDAQ today started off looking great, and then all of a sudden we had a negative 1.8% slide. Fortunately for me, my positions are pretty close to entry price, so great. I'm not, break out the hammers. Well, we'll see. I don't see too many good hammers there today, but you look at the tech side of things today, and obviously you guys know I have the 210 Tesla puts, so I should be fine there. Your NVIDIA was still at 115. I own it at 115, plus I've been selling calls against it, so if it closes above 115, my NVIDIA will get taken away. I hope it drops tomorrow, really. I want it to sell off here and get a little bit lower than 115. And then what else do I have? We had the Tesla. I got SMCI. So I have the $40 strikes on SMCI. We'll see how that works. Right now, we're down below that at 39.15. So if everything stays right where it's at, I'll be a happy camper. Actually, a pretty darn good week for me. MicroStrategy as well. MicroStrategy, I'm surprised it didn't sell off as much as it should have. This is very interesting to me. So for those of us who are following MicroStrategy and its relationship to Bitcoin, MicroStrategy was up 0.27% today, and Bitcoin is down 3%. Right, you would think there'd be a tighter correlation there. I was really expecting this to fall apart. Yeah, I did. Sorry, Big Up. I dumped Trade Desk. I'm taking a loss on that one. That chart looks way too bad. I thought we'd have a bounce, and and of course now it's going to go up. So if you guys are looking at something to buy, Trade Desk is probably going to go screaming up here because I finally dumped my position. Did it yesterday, so I luckily saved a little bit. It's down 10% today, but. Yeah, I took a loss on that one. Good news, it was a small position, so I'm not too concerned about that. But, man, what a fall. Look at that thing. Just from that day that it reported those earnings, it gapped down on earnings 30%, and right now the Trade Desk is down 52%. Oh, no, even more than that. Sorry. It is down 56%. Yeah. Yeah, at a certain point, we were getting no bounces there. It was just nothing looked good. As we came into this $60 area, I thought we were hold, did not dump it. I'm fine to take a loss on it. Yeah, big down day today. But you know how it works. As soon as you get out of something that you've been holding on to and you're like, I know I shouldn't hold this, and you're like, finally dump it, that's when it rips. So tomorrow will be like a 30% up day for the trade desk. Watch. The 30% up day. A-net tanking too? Oh, yeah. Yeah, that one's been pretty dang consistent, hasn't it? Let's see, it's down 39%. 39. Yeah, I would think so too, Big Eb. Big Eb says must be something else going on with the trade desk or TTD. Yeah, there's got to be something here that's like program selling. I mean, they really have had not even the slightest up day for the trade desk. I'm trying to find green candles in here, and yeah, there's some tiny little ones, but it's just literally been down, 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 down every day. Steve says 40 is the next area. I wouldn't touch it. I think Big Eb's right. I think something's wrong. Something internally happened here with the trade desk. You know, does it have a book value? Does it fall to that price? I don't know, but I'm done with it. I'll leave it alone. I mean, if we get down to 40, you're way down here. Do I take another stab at it if we get to 40? I don't know. I like to just, especially on ones like this that are down so much. I mean, this is a 25% loss. I'll be happy just to walk away and leave it alone. 25% loss on that one in what, 3 weeks? Yeah. Bum, bum, bum. So 80 was my strike. So, yeah, 20% loss in 3 weeks. Ouch. Yowzas. 25%. And I'm going to leave you with one last little piece. So let's look at economic calendar. Gosh, why can't I do a 30-minute show? What's wrong with me? From an economic perspective, you don't have anything tomorrow that is as exciting as what we saw today. So here's the numbers coming out for tomorrow. You really have a GDP number coming out for England. We have University of Michigan consumer sentiment number. So there you go. Nothing that big. I think the big stuff is already out. And on the earnings front, you don't really have much either. So as usual, I always like interesting charts. And maybe, do I have a graphic for this? Ooh, maybe I do. No, I thought I had one that said like chart of the day. Oh, there it is. Here you go. Here's your chart of the day, chart of the week. I'll give you this. Chart of the week. Here's your chart of the week. It is the FHA subprime bubble. And it's showing you the shares of borrowers, the percentage of borrowers with debt to income ratios over 43%. And back here in 2008, when all of a sudden we had this issue with subprime borrowers and things were looking pretty bad, this is 2008, we were at like 43%. We are currently at 64% of borrowers for FHA loans that have a debt-to-income ratio, 43% of them have a debt-to-income ratio of 64% or more. That can't end well. When you have, it just doesn't seem good for me. This means way more debt than income. And that puts people in a big financial burden. And if we had debt-to-income ratios at 43% back in 2008, and that caused that giant financial crisis, what level does this catch up with the markets and we see this start to tank again? 64% right now. Crazy. Anyway, that's your chart of the day. That's your chart of the day, or chart of the week. Maybe I should change the chart of the day. I haven't changed the chart of the day because maybe I can do one every day, although it's more work for me to do. But anyway, that's your economic show for today. That's the Trader Merlin show for today. I hope you enjoyed it. Who knows what on earth is going to happen tomorrow? I mean, we did not end on a positive footing. Things look rather negative as we got to the close. You know, my gut tells me you're going to have a sharp rally here soon, but right now the trend is your friend until the bend at the end. Foreclosures were held back in the past several years. That's true because of COVID, and maybe we'll start to see more of those foreclosures come in. Save up your cash, set up some income streams, make better trades. 30 minutes is impossible. And Big Eb, you know I'm going to do a 30-minute show tomorrow just to not be impossible. That's Friday. I'll have to do a longer show. All right, everybody, that's going to do it for me. I got to run. Have a fantastic remainder of your day. If you got questions, email me at tradermerlin@gmail.com. If you're brand new, subscribe, hit that like button. I'll see you guys tomorrow. Take care.